Okay, let's talk about cash, fraud, and internal controls here. Excuse me. All right, so cash, let's talk about internal controls first. All right, so what is internal controls? Well, it's mainly policies and procedures that we use to do several things. First is to protect the assets of the company. Second, by having proper policies and procedures, we hope to ensure reliable accounting. Um, this seems circular, but I'll go ahead and mention it. Policies and procedures help managers to uphold company policies. Uh, Seems a little circular, but okay. Last but not least, it helps promote efficient operations. So I would agree with three of those. Um, I guess the procedures help uphold company policies for that third one. We mentioned Sarbanes-Oxley Act, and for companies that are publicly held, meaning they sell their stock on public stock markets, uh, the Act requires managers and auditors of public companies to document and certify the system of internal controls. And so Section 404 of SOX requires that the managers document and assess the effectiveness of all internal control processes that can impact financial reporting. So some common internal control procedures are the following, and this is true regardless of the type of company, and of course the size can affect how well you do this, but uh, regardless of the size, these are at least good principles to follow. Establish responsibilities, because by establishing responsibilities for certain tasks, if something goes wrong, you know who's responsible for it. If you've got two people doing uh, one responsibility and something goes wrong, you don't know uh, who is at fault, who is accountable. Maintain adequate records. And I would say better than adequate records. And so this helps to, well, helps for a lot of reasons. It helps you keep score for accounting reasons. If you don't have adequate records, you can't keep good score. And here, for uh, financial purposes, keeping score means uh, the results of the financial results of your operations. It also helps you make sure that um, assets of the company are safeguarded. If you don't have proper records concerning, let's say, your equipment, how are you going to know what equipment you own? Certainly, as you grow, that can be a real problem. Insure assets and bond key employees. Insurance should be a big part of protecting assets in case something happens to them, whether it's through theft or some sort of casualty. As far as bonding is concerned, a bond is a guarantee by an insurance company, and so what happens is the the insurance company checks the backgrounds of your new employees, especially the ones who are handling sensitive records. And so those are usually the ones you want to bond, those who are handling sensitive records like accounting records or handling cash. And what this bond gives the company is assurance that if they have a loss due to theft or fraud by one of these bonded employees, they can make a claim on the bond with the insurance company. And of course, the insurance company, of course, would come after the now former employee if there was theft or fraud, but that's not the company's concern. The company's only concern is finding the fraud or theft and getting rid of the employee and then making their claim with the bond company. You want to separate record keeping from the custody of assets, because if you combine those two jobs, it makes it easier for that employee to hide any theft or fraud. If they have access to record keeping and also have custody of the assets, such as cash. Cash is an asset, remember. If they have custody of the cash and they also have access to record keeping, they could easily falsify the records to show that the assets that they steal don't exist any longer. And we'll talk about how that happens here shortly. You want to divide responsibilities for related transactions. Now, you don't want to duplicate efforts here, but essentially what you want to do is you want to, for instance, purchasing. You want to have, you want to break purchasing and the disbursement of cash for those purchases separated out. And you want to make sure that there's a separate area for receiving assets that are purchased. So, you know, you divide that out. You have the purchase, you have the receipt of the asset that's purchased, and then you have the payment for the asset that was purchased. You want to divide those responsibilities for that related transaction. You want to apply technological controls, and last, you want to perform regular and independent reviews. Now, technology can help in identifying fraud and assisting with internal control. It can do this by reduced processing errors. It gives you the ability to have more extensive testing of the records than a manual system would. It helps separate duties. And while they provide limited evidence of processing, you know, you don't need, for instance, hard copies, but it does allow for some new evidence. Um, you can, for instance, check who made a record of an entry and so on. And of course, with technology and you've got e-commerce going on, that certainly helps with that as well. Now, what are some of the limitations of internal control? Well, human error. There's going to be stuff that happens, and certainly the old adage that garbage in, garbage out. If you've got somebody inputting the wrong information or in the wrong account, wrong amounts, stuff like that, we're all human and mistakes happen. So human error can come from negligence, fatigue, misjudgment, or confusion. Now, compare that with fraud. Here you have an intent to defeat these internal controls for your own gain. And of course, we talked earlier about the triple threat of fraud being, first you have to have the opportunity. The opportunity has to be present. Well, how do you give persons the opportunity? Well, it usually happens where, like we talked about, you've got somebody who has both the possession of an asset, such as cash, and they also have access to record keeping. It might surprise you that, or maybe not, that a lot of fraud is done by accountants. Why? Because especially in small companies, they have access to both checks as well as they're able to manipulate the records, the accounting records. So they're in a prime position to have the opportunity to commit fraud. Pressure, usually that comes from some external force such as debts, problems in relationships, dependency, psychological problems, et cetera, et cetera, et cetera. Maybe all of the above. And then the rationalization is simply saying, well, I deserve to do this. I deserve to have this money. And recall that the costs of internal controls cannot exceed their benefits. It doesn't make any sense to do that. All right, so let's look at cash and its equivalents, because and why are we talking about internal controls and then cash? Well, the reason why is because it's the most liquid asset there is in a company, and because it's the most liquid, those who would perpetrate a fraud on the company find it to be the most desirable. It's once you steal cash from a company, it's hard to identify. So every dollar looks the same. So plus, I mean, if you steal inventory, unless you absolutely want that piece of inventory. Uh, more than likely what you want is the cash. You've got to turn around and convert that asset of inventory into cash. Well, with cash, you don't have to do that. You don't have to convert it. So that's the greatest of all worlds, is to steal cash. And so an effective system of internal controls for cash start with the 3 basic guidelines. The first deals with separation of duties, and so handling cash is separated from the record keeping for cash. Any cash receipts received into the company should be deposited in a bank, preferably daily, and cash disbursements should be made by either check or electronic funds transfer. No, except for small amounts, there should be no cash purchases. Now, when we talk about cash, we really are talking about cash and other similar assets, and so it includes currency, the green stuff, coins, any deposits, any amounts in bank accounts, checking accounts, savings accounts. That includes checks, cashier checks, customer checks, certified checks, and money orders. It also includes something called cash equivalents. And what we'll talk about here soon is talking about tenets of good cash management. And one of the things that you will have when you're managing your cash effectively is you'll have something called cash equivalents, which are short-term, highly liquid investments that are readily convertible to a known cash amount, and it's also close to the maturity date and not sensitive to interest rate changes. These cash equivalents have to have a maturity date of not longer than 90 days. Well, and some examples of cash equivalents are treasury bonds and CDs. Why do you invest in cash equivalents and not just have it in cash? Well, if you the idea is to invest your excess cash, and these cash equivalents allow you to do so for a short amount of time, and so you get interest income, you obtain interest income from these cash equivalents. Otherwise, if you didn't invest these in cash equivalents, this money would just sit in the bank account and would not earn as much, or maybe nothing. So you don't want to do that. You want to invest excess cash, and so these cash equivalents allow you to do so and still have pretty easy access to it once you need the cash. So the goals of cash management are twofold: plan cash receipts to meet cash payments when due, and keep a minimum level of cash necessary to operate. And so effective cash management involves applying the following principles. Encourage collection of receivables. You can do this by offering cash discounts to companies you sell on credit. If you notice that a customer is paying late, call them up. Find out where the payment is. As far as payment of liabilities, you always want to delay payment until the due date. Certainly you want to take advantage of any cash discounts you can take with your suppliers, though. Keep only necessary assets. Plan expenditures, major expenditures especially. And last but not least, invest excess cash, and that's where those cash equivalents come in. So let's apply internal controls to cash receipts and disbursements. And so this graphic indicates or illustrates that how you would handle cash receipts coming in over the counter. And so first you're going to have a clerk ring up a cash sale on the register, and at the end of their shift, they're going to prepare a cash count sheet and keep a copy of it, and they're going to send the cashier a copy of the receipt or the count sheet along with the cash. I mean, you see this when you go to Fred Meyer or Walmart, wherever. You see these cashiers, when they begin their shift, they come to the register that they're working with a cash drawer, and that cash drawer has a certain amount of money in it. And the cash register rings up all the sales. It has the record of sales during that cash clerk's shift, and at the end of their shift, they should have an X amount of money remaining in their drawer. And so they'll make a physical count of the cash remaining in the drawer and print a ticket out of the transactions for that period on that register, and it all should reconcile. And so the cashier sends a copy of the register data and there has to be a third party, a supervisor, who reads this register data and prepares a register sheet and sends both back to the company cashier. So you've got different parties doing different things. And the cashier is going to prepare cash records, a deposit slip, and prepare a journal entry. So what do you got going on here? Well, you've got Um, you've got someone doing the sales. Um, they give the money to the cashier, but they keep a record of everything. Cashier prepares the cash records, a deposit slip, and makes a journal entry. And the supervisor is there to verify the register data and a register sheet. So, I mean, that's about as good as internal control as you're going to get, although you might have a third party who's not the cashier doing the deposit slip and journal entry, because, I don't know, that to me seems like a break in the separation of duties, but hey, because they've got the cash and, you know, they're making the deposit slip and the journal entry. Anyway, all right, let's move over cash over in short and talk about cash receipts by mail. Best thing to do for a company and a good policy to keep is don't receive cash in the mail from your customers. The best thing to do is have your customers send money either one of two ways, either by EFT directly to your bank, or if they're sending a check, send it to a bank lockbox. A bank lockbox looks like a PO box on the invoice you send them, but the PO box is actually at the bank, and it allows the bank to go to the lockbox each day, take out the checks that have been received in the lockbox, take and process those checks each day, and send you copies of the checks along with copies of the advice that's attached to the check. And so by doing that, you don't get checks coming into the company, and so you don't have to worry about maybe that check being stolen by one of your workers. But if you do have checks, you want to make sure that you have two people assigned to opening the mail that has checks in them. That way you have two people verifying what's coming in, and then one of those persons needs to make a record of the checks received, and they're going to keep a copy of that and give another copy of the checks to, well, the checks, actual checks, along with a copy of the record of all, list of all checks, to the cashier who's going to make the deposit of the checks in the bank. And the cashier is going to send the record keeper, the accountant, for receipts, a copy of the deposit slip along with a copy of what they got from the persons who opened the mail, and so that they can record receipts of the checks in the accounting records. Now, as far as cash disbursements, you can have problems with this because you could have set up dummy vendors and have the dummy vendors send invoices to the company and pay those invoices And if you're the one who set up the dummy vendor, you would have the checks that are dispersed going to a P.O. box, and then, of course, that P.O. box is rented by you. You would go pick up the checks and cash them. So this is an important area where you need to have a system of cash disbursements. Again, separation of duties involved here. And so keys to controlling cash disbursements is, number one, require all expenditures be paid by check or EFT, and limit access to checks except for those who have the authority to sign the checks. A good way of making sure that you protect disbursements is to have what's called a voucher system of disbursements. And this establishes procedures for verifying, approving, and recording obligations of cash disbursements. And it also establishes procedures for issuing checks for payment of verified, approved, and recorded obligations. Well, how does it do that? Well, you've got several players involved in this disbursement process. Usually it starts with someone requesting that a disbursement be made or an acquisition be made. And so the person needing the acquisition to be made will fill out a purchase requisition, or purchase requisition, or a purchase order. And of course it has to go to someone else, the purchase order, to be approved, usually a supervisor. And from there it goes to the purchasing department, who are responsible for knowing the proper vendors and knowing the best way of buying certain things. So it'll go to the purchasing department. They'll purchase it from the proper vendor at the proper price, and will send a copy of the purchase order to the vendor. The vendor will ship the product to the company. When the product is received by the company, it will be received by what's called the receiving department, and the receiving department will have a receiving report. On top of that, the company or the supplier will receive, the supplier will send a copy of an invoice to the company who purchased the item. So you've got several things going on there. You've got a purchase requisition, you've got a purchase order, you've got an invoice from a third party, you've got a receiving report from the receiving department, the dock, if you will, the loading dock. All that information will come to disbursement accounting. They will reconcile the documents. They will look at all the documents and make sure that they all say the same thing, that the request was made, that the request was approved and a purchase order was granted, that the invoice matches up, that the number of items that were bought were received by the company, and based upon that, they will send this invoice approval to the cashier, and the cashier will prepare a check, and the check will be signed by somebody in authority. Let's say it's the treasurer or CFO of the company. So notice you've got several different departments, several different players involved in this disbursement process. And by having several different players, it really cuts down on the amount of chances of fraud. The percentage of chances of fraud goes way down when you have the proper separation of duties. You know, if you had that type of system, it would take a real system of collusion, a real scheme of collusion by different parties in different departments in order to perpetrate a fraud. We're going to pass over petty cash. Not a big deal for most companies. All right, a bank. Companies have to have bank accounts, but they also help with internal controls because they are a good third-party verification, and thus aid in proper internal control. And so some of the things involved in bank services, first are signature cards. You only want certain few key employees to have signing authority on checks. And so the people designated in the company for signing authority will sign a signature card, and that signature card will be on record with the bank so that the bank can compare signatures of the designated signers with the signature on checks. You have deposit tickets, you have bank statements, you have EFT, you have the checks, the pre-printed checks that are in numerical order, and of course you have your bank accounts. All these help with establishing good internal controls for your cash. And at least once a month, what you'll get is bank statement. Now, let's face it, with electronic banking these days, you could do this on a daily basis. You could reconcile your bank account daily. That may be a little bit of an overkill, so I wouldn't suggest you do that, but certainly you need to do this once a month. And so let's say that it is done once a month. You need to reconcile the bank balance with your book balance. And the person who should do this is someone who has no connection with record keeping for cash, nor does it need to be someone who has access to be cash. Usually somebody in internal audit is the one who reconciles the bank statement. And so you're going to have this person prepare a bank reconciliation. And what this reconciliation does is it explains the difference between cash reported on the bank statement versus the cash balance on the company books, because of there's hardly going to be the exact amount in both. Why? Because you've got stuff coming in that you don't know about. You could have deposits that the bank hasn't recorded yet. You could have checks that you've written but have not cleared the bank. There's all kinds of reasons why the bank balance and the book balance don't match. And so you've got to reconcile the records for these differences. And so as far as the bank balance is concerned, you have to take that cash balance that the bank shows, and you have to add and subtract certain things. You're going to add deposits in transit. Deposits in transit are deposits that you've made in the bank but have not yet been recorded by the bank on their books. Any checks that have not cleared the bank but you've written and sent must be subtracted from the bank balance. Deposits in transit have to be added. And then if the bank has made some errors or noted some errors, that could be a plus or a minus. It just depends. And what you're going to get is an adjusted bank balance. And then you're going to look at your book balance and make some adjustments there. If, for instance, somehow the bank was involved in collecting certain monies from customers, then you might have a collection you don't know about. Certainly, if you accrue interest on your checking account, you're not going to know about that until you get your bank statement, so you have to add that. If some customer writes an NSF check to you, what happened when you deposited the NSF check, they added that amount to your account when you deposited it. Well, when it came back as insufficient funds, you're not going to know about it necessarily until sometime later when you get your bank statement. You've got to subtract that amount from your cash balance. And so you added it to your books when you received the check. Now you got to reverse that because the check wasn't any good. And then, of course, if there are errors, you've got to take care of those as well. And so the bottom line is your adjusted book balance should be the same as your adjusted bank balance after all these ins and outs. Now, on top of reconciliation, the adjusting entries need to be made to reconcile the items on the book side of the reconciliation. The collections of interest and the collections and interest and the NSF checks. The other thing they don't have in here is if there's some service charges that show up on the bank statement that you didn't know about previously, you've got to make adjustments for those as well. And so here we show a bank reconciliation, and the book talks about 9 steps that you would use. And so first thing you want to do is figure out the bank statement balance of cash, and then you want to add any deposits in transit, subtotal those amounts, and then figure out how many, what outstanding checks you have. And in this case, you have no errors, plus or minus, and so that's going to be your adjusted bank balance. And then you're going to determine your book balance, and to the book balance you would add any amounts collected or interest earned, and you're going to deduct any charges or service fees. And then you're going to add and subtract those, and what you're going to come up with is the adjusted book balance. Okay? And hopefully what you'll come up with is an equal amount on both sides. If that is the case, then you are ready to make your adjusting entries, and those adjusting entries are going to come from the book balance side. You're going to have to make adjusting entries for the collection of $485. You're going to have to make a entry for the interest earned, as well as the check printing charge and the NSF check service fee. And so here are those entries. They collected $485 of cash, less a collection expense by the bank. This was a note receivable that was collected by the bank. Next, you've got the interest revenue. So there you add $8 to cash, and I recognize $8 in interest revenue as your credit. And then you could have something like check printing fees, 23, or here they just have miscellaneous expenses and take the cash out as your credit. And then last but not least, because that was you got a NSF check, you're going to have to, since you previously noted in this customer's accounts receivable account that they had paid this amount, you've got to put that back on your books as being owed. And so you're going to debit the customer's receivable account, and of course your credit's going to be a reduction in cash. All right, so that's it for Chapter 6. Next is Chapter 7, dealing with receivables.